Welcome to Finance Deep Dive. Have you ever wondered how a company that looks incredibly successful on paper, making headlines, seemingly rolling in dough, can suddenly just go out of business?
In this video, we're going to solve that exact mystery. And the answer, believe it or not, is hidden in plain sight.
The solution lies in understanding a company's three key financial reports. Okay, let's start breaking them down, one by one.
Our first clue is what I like to call the financial snapshot.
This is the balance sheet. And think of it like this. It's a single photo of a company's financial health on one specific day. It just freezes a moment in time.
It simply shows two things. On one side, everything the company owns. On the other, everything it owes. That's simple.
So let's look at our example company, Delicious. On December 31st, they owned $169 million in assets, and they owed the exact same amount.
And this right here perfectly illustrates the golden rule of accounting. Assets have to equal liabilities plus equity. The books always have to balance.
So, Delicious looks pretty stable, right? But this is just one piece of the puzzle. Let's move to our second clue and see how the story builds.
Okay, so if the balance sheet is a photo, the income statement is the movie. It shows you the company's performance over an entire year. And the plot of this movie is pretty simple. You start with all the money you made, you subtract all your costs, and then you see what's left.
And for Delicious, the movie had a happy ending. They made a profit of $7 million. On paper, that's a really successful year.
This sounds great, doesn't it? But hold on. Here's the multi-million-dollar question that gets us right back to solving our big mystery.
We'll answer that in just a moment. And hey, if you're liking the content, do us a favor and hit that subscribe button. It really motivates us to keep posting.
Okay, now for the final clue, the one that reveals everything. We need to follow the actual cash.
So here's the crucial point. Profit is not the same as cash. Let me say that again. Profit is not cash. Profit is what you've earned on paper. Cash is the actual money in your bank account. The cash flow statement tracks every single dollar that actually came in or went out of the business. It doesn't care about promises or paper gains, just cold, hard cash.
It breaks this down into three main activities. You've got your day-to-day operations, like selling tea, long-term investments, like buying new equipment, and how the business is funded, stuff like taking out loan.
And here it is, the big reveal. Despite that $7 million profit on paper, Delicious only actually increased its cash in the bank by $1 million. See? Now you can totally see how a so-called profitable company can actually run out of cash. So, what's the big takeaway from all this?
Well, each statement tells a different part of the story. You need all three to really understand a company's true health: the snapshot, the movie, and the cash trail.
One statement by itself can be super misleading. A company can show a huge profit but have no cash, or have tons of assets but be drowning in debt. Together, though, they give you the complete picture of financial reality.
That's all for this video. Thanks for watching, and don't forget to subscribe for more finance deep dives that make complex topics simple. And we'll leave you with a final thought to chew on. If you are a brand new investor, which of these three statements do you think is the most important one to look at first? Let us know in the comments.
Thank you.